not like that. Hello and welcome to our IGTV video. My name is Andrew Kuhn, Focus Compounding, sitting next to Geoff Gannon, Focus Compounding. Say hi to the camera.
Hi.
Say hi a little louder.
Hi.
This is a new segment or topic that we're going to be trying to mess around with. Obviously, we just created an Instagram, and I'm told that we can upload videos up to 10 minutes on Instagram. So we're at the office right now. It is Sunday, so I thought, why not try to talk about a topic on investing. So tell the people, what do you typically look for in an annual report that stands out to you for it to be a good business? What are you typically looking for?
I'm looking for a description of the business model, an understanding of the key performance indicators, the things that drive the business, and that they can talk about that clearly, and that management understands it and can talk in sort of plain English about it. Yeah.
Okay, so the first thing that you do when you open up an annual report is what? I guess the first thing you do, so when you actually look at a company, is it, do you go to the annual report first? Do you read the investor presentation first? Do you try reading a bunch of other blogs on it to kind of get caught up on the idea more? What's your process like for that?
If I know that I'm really going to read about it, that it might be an overlooked stock and stuff, then I just read the annual report. If I have no idea about the stock, that it could be of interest at all, then I might read an investor presentation or a blog post or something. Yeah.
Okay, cool. So we open up the annual report, we go to Edgar, or if it's an overseas site, maybe you go to the website. And then what's the first thing you do? You read the business description? Do you see where it's incorporated? Do you check the shares outstanding? I mean, what do you typically do with that?
I read the business description, but yeah, I always know that the shares outstanding, that's important. I was just looking at Sydney Airport, and I quickly calculated the number of passengers per share. So about 20 passengers per share is what you're buying.
Really? So a lot of people would not do that, I feel like.
It was very important. And I also converted everything they were saying in Australian dollars to US dollars to see how much they're making per passenger and to check that. So like if they're making $3 per passenger for like parking and stuff, that makes sense, right? But if it came out to $30, like, oh, that's really weird. That can't be right. You know, something my math is wrong. But it came out to the normal numbers I expected. Yeah.
Got it. Okay, so you read the business description. It's something that you could potentially understand, right? There's been business descriptions I've read before in the past, and I'm like, there's just no way I could figure this company out. There's companies like that. I'm just like, I just cannot picture this. I just don't understand it. And for me, if I'm not interested in it, I just can't learn about it. You know, it's too complicated. But so then I put it into our pile. But from there, I think you can learn a lot about a business from the risk section. Yeah. Right. A lot of the risk is sort of boilerplate. It's written by lawyers for lawyers. But a lot of companies, if they put out good information, you could really learn a lot about a business just from the risk section, in my opinion. Yeah. What are you typically looking for in that section?
Descriptions of things that are specific to the business that would be a risk. Sometimes the descriptions and the risks are actually positive things, I would say. So I mentioned Sydney Airport, the big risk there is debt. So I wanted to know how they think about debt, how much they would space it out, whether they put it all in one currency, things like that. So the big concern would be debt. With other companies, it might be things like customer concentration. We just looked at a couple of companies where they had very high supplier concentration or customer concentration or both. I wrote about one for the website that had basically one supplier and two customers. And so that's a risk.
Which would be very scary.
And one site.
Yeah, very scary. Okay, so then I guess we could go to the balance sheet, income statement, cash flow statement. First thing I typically look for is like the liquidity position, I guess you could say. So current assets to total liabilities, or you could do total assets to total liabilities and the relationship between those two metrics. What are you typically looking for? Yeah,
I'm looking to see the first thing I would look is just our current assets greater than total liabilities. If so, are they greater by so much that the difference is the cash position? If that's true, then you have a company that's really overcapitalized. For other companies, they could have lots of liabilities, but then I have to start learning about it. But if they have way more current assets than total liabilities, then I know that I don't have to care that much about them.
Because it's very liquid, essentially.
Yeah, it's safe. I do actually do the same calculation all the time, though, which is I add together inventory, receivables, property, plant, and equipment, and then I subtract out accounts payable and accrued expenses, and that gives me the tangible investment in the business. And I always do that calculation. That's something I look at very quickly. Yeah. And I look in terms of turns and margins. Turns, I probably focus more on turns than most people do because
the inventory turns.
Capital turns. Yeah, it could be inventory turns, but literally capital turns of what I just said.
So how many times they turn their capital over per year or per quarter?
Yeah. So if you take inventory, receivables, and PP&E together, how much is sales versus that number really? Yeah.
And then we can go to the income statement. Obviously, first thing I typically look for is, I guess, growth in revenue, but really more so the margins. And if you're taking data over, 1, 2, 3, 4, 5, 10 years to the sort of, I guess you could say, the stability of those margins, both like gross profit, EBIT, and net margins, even though net margins could obviously be a little bit more fluctuated. But what are you typically looking for there?
Yeah. So are the margins stable? Things like that. The big thing that I would look at is, are sales going up each year? Is gross profit going up each year? And then also I'm looking really at like leverage, operational leverage, or economies of scale, or something like that is a big one. Do I think that they can grow things below the gross profit line faster than gross profit or something like that? So basically, do I think their operating expenses can stay stable while they grow other things? So then maybe if that's true, then they could grow earnings faster than sales. For most companies we're looking at, I don't think they can grow earnings faster than sales.
And that's one of the things actually I look for, like when I go on Quick FS and I look at the revenue CAGR, I kind of compare that relationship to the EPS CAGR.
Right.
And now if there's like, for example, revenue has grown 6% per year for the past 10 years, and EPS has grown by 15 or 20%, I kind of think that's interesting and want to learn a little bit more about that.
Yeah.
Okay, so let's go to the cash flow statement.
Okay.
What do you typically look for first? The free cash?
So I do the free cash flow. The first thing I do is free cash flow calculation. So that's just taking the cash flow from operations. For U.S. companies, this is how it'll be presented. You take the cash flow from operations for each of the last couple of years. It might present 2 years on the statement, but I like to do 3 years. But if it presents 2, you can do that. I add both years up, and the cash flow from operations, I subtract out the CapEx. I subtract out the CapEx without doing things like adding back the disposals and things like that. Quickly get a calculation from that. That gives me an idea of free cash flow. Compare that to reported net income, usually is one of the big things. How close is free cash flow to reported earnings?
Yeah, because if they have some form of float or something like that.
Yeah, I just wrote about a company recently for the website where I said the problem is that although it's growing as fast as many other companies that we're interested in years that it grows, it sometimes only converts about half of its earnings into free cash flow, which is fine. It's reinvesting the rest to grow.
Yeah.
But that means that it has to grow pretty fast to justify that. Whereas a company that's converting all of the earnings per share into free cash flow can grow a lot slower and still be a good investment at the same price as that other company.
Sure. And then let's say the notes to the financial statements or like the MD&A section of the annual report. I mean, what are you typically looking for? I mean, revenue recognition obviously is very important. How they account for inventory. What else are you looking for?
I'm really looking for the unusual items. So like we were talking about a company that had that one supplier and 2 customers. What I noticed is that it has extremely high inventory levels, and that all the inventory levels are raw materials, not finished product.
Yeah.
So what I guessed from that, which I found out by reading the annual report and stuff was true, is that they're a just-in-time company. So they have to accept all of the suppliers' supply to them regardless. So they can just deposit it there and keep dropping it off. But they actually only supply their customers basically just in time, which is an important thing to understand because it might mean that's why the customer's doing it, so they don't have their plant have a lot of inventory and stuff. So it was just, that was noticeable because raw materials in that case was like maybe 20 times higher than finished inventory, and of course it's also being carried at in dollar amounts.
Sure.
So raw materials should be worth a lot less. So that just tells you in terms of physical volume that if you went there, 95, 99, whatever % of the stuff you saw will be raw material. So that is very weird, and it's just something that's listed in the inventory. Yeah.
What else? Anything else comes to mind?
No, I mean, they're all things. So like it gives you receivable concentration versus sales concentration. So one thing you'll notice is if it says that 90% of our receivables are from 2 customers, but only 40% of our sales are from 2 customers, that probably, that very strongly suggests that they're giving preferential treatment to their biggest customers, which is pretty normal. I'd say usually if there's customer concentration, the receivable concentration will be even higher than the sales concentration. But it's a way that you can find out guesses of things that they might not tell you otherwise. And then of course you could ask the CFO or whatever, is that what's happening? And they'll probably admit that's true,
Got it, cool. And then from there, do you usually read the investor presentation to see what they're...
I always read the most recent investor presentation.
And I think that's a good way to kind of get caught up in the business plan. All right, that is, we have 10-minute maximum duration for video, and we are at 8 minutes and 50 seconds, so we're going to wrap it up here. We got 3 podcasts coming out this week, very excited for it. Burford Capital is tomorrow, and then we are doing a 5 stock snap judgment podcast, and then also we're going to talk about valuations and how we think about returns. So we will see you in all those podcasts. Enjoy your Sunday. Take care.